Hello and welcome to FreeFX. My name is Francesco Sani, and today the trading video is a new beginner series, and this is the first video of the series. And today is the 24th of April 2016, and we're going to introduce, as usual, the disclaimer. Remember that FreeFX is an educational resource, and all information shown does not constitute trading advice, and there's a risk of financial loss in trading foreign exchange. And the topic of the day is make a trading plan. So I start today's trading video with the following, which is the questionnaire. So the questions you should ask yourself when you start this is a series of 6, and I put them into the following order. First question is why. Okay, so the why question is, why am I trading? So ask yourself before you start trading. You probably heard from somebody, my guess is, or you read a website or somewhere, somehow you came across the idea that you should trade Forex, and you became interested in it, and something started from there. So, but the first question is why? Why are you trading? Are you trading because you want to get rich? Are you trade because you are attracted by the idea of making money from money? So without actually, selling and buying real stock, or are you just trading because you have some capital that you'd like to appreciate? So what are the reasons why you're trading? And for that, I'm going to go to the website called Futures Mag, and this is a website, and it has this article from 2014. I was trying to get recent articles. This one is 10 reasons for trading Forex, and it starts with number 1, which is diversification. So investing in the FX markets allows you to maintain a security of cash while benefiting from higher interest rates provided by other countries' central banks. So for example, at the moment, the Kiwi dollar, so the New Zealand dollar, is the highest yielding currency of the majors group. So if you bought New Zealand dollars against the US dollar or any other counterparts like the euro, the pound, the yen, and the Aussie, etc., you would benefit from the interest rate difference. So that's one thing. And the other reason, again, second of 10 here, liquidity is one of the most liquid markets in the world. So $5 trillion traded in G10 currencies. This is 2014, so that's probably gone up or possibly stayed the same, but it's a big market. So 3, regulation. Until recently, there was no central regulation, and it had great problems in terms of oversight, but there is a greater supervision, and there is legislation to register all brokers with the CFTC, which is the Commodity Futures Trading Commission. So moving on to other reasons why: transparency, it's a transparent market, and market access, very easy, and it's 24 hours a day, so you can trade 24 hours a day, 5 days a week. And also leverage, what allows you to put in less money than is needed to trade, and your broker fills in the rest. So in other markets, like if you traded futures, etc., there is a possibility also to leverage to some degree, but Forex really allows more leverage. This is a double-edged sword, obviously, where you can, as it says here, you can lose money as fast as you can make it. So again, the other reasons are carry trading, again, the interest rate differential between different currencies. So you buy a higher yielding currency versus a lesser yielding currency, and you hold on to that trade for, say, months, and you take the overnight interest on top of that. And so the more you bet on that trade, the higher your interest over time, the more money you make, as well as the pip movement. And no fixed contract size, so you're not obliged to buy a certain number of contracts, like with futures, for example. So you can buy as little as nano lot or whatever, so £1,000 or dollars. Another two reasons might be: one is no commission fees. Well, this kind of depends on your broker, obviously, so that's something to bear in mind. So we'll just refresh that. It seems to have gone blank. Well, okay, so for some reason it's not working after that. Anyway, let's move on to the next topic, which is which broker. So first of all, ask yourself why you're trading. Second, when you decided, so the reasons why you're trading, that helps you to find a broker. So for example, depending on the reasons why you're trading, you might decide to invest with a broker that allows you access to certain currencies. If you want to trade Forex, we're dealing with Forex here, obviously, so this is probably why. And so you need to select a broker, obviously, that allows you to trade currencies, foreign exchange, or Forex, or FX if you want. And there are several brokers. You have a choice of a vast array of brokers. I don't make recommendations here. I personally trade and have always traded since I started 3.5 years ago with FXCM, which is Forex Capital Markets. Not a recommendation, just what I use. And there are several brokers. They are no dealing desks, so they don't trade against you. They pass on your trade. There's a liquidity provider, and they act as the middle person. It's quite a complex thing, and there have been a lot of discussions on trading forums over on BabyPips.com about this idea of who takes the losses in a way. So when your trade is successful, so you're making money out of your broker, how does the broker basically deal with that loss? Do they make up that loss by taking trades against people like you or other traders? That would be a dealing desk where the trades are managed by the broker. There have been a lot of discussions on this, so I'm not going to go into that now. You'll find on the forums it is a hotly debated topic whether the brokers are out to make money out of you. Chances are that's not necessarily the case. It may be that they make money out of the spread, so every trade you lose, you've paid for the spread. So and also every trade you win, you still pay the spread. So the spread they charge, so the cost between the ask and the buy and the sell, the bid and ask, is essentially what they make their money from. But regardless of that, you want to try and get a no dealing desk. So if we are going to go into that, I would go into this. There's an article here actually which I spotted on Forex Crunch, and it's an article from 2014, and it says that there has been a lot of promotion of the no dealing desk broker, and that essentially by abolishing the dealing desk, companies are hoping to win back some business, and a lot of people have basically got smart and they don't want to be trading against a broker, so they want that trade to be transparent. So there's an article here about what actually the difference between no dealing desk brokers and ECM brokers. They're not the same thing. So depending on how much you trade, how much capital you're going to trade, which is our next point, you may want to choose a standard, so to speak, broker or an ECN broker. So ECN stands for Electronic Communication Network Brokers, and they offer particular services. They usually require higher deposits on accounts, this article here from dailyforex.com gives you a list of some ECM brokers: Trio Markets, FX Pro, FXCC, and I couldn't find the date of this article, so there may be other ECM brokers that have come up. But anyway, that's sort of what this article gives you. I'm going to close that, go back to our list. So, so why are you trading? Which broker you should use? Then the third question again, and they came up in our broker discussion, how much can I invest? So this question relates to your capital. And this again has been discussed hotly on babypips.com and probably other forums. And this really depends on what you decide as your reason for trading. For example, if you're trading because you want to retire and you want to reinvest some of your savings, and this is something that the Online Trading Academy talks a lot about, is to basically be smart about how you make a retirement fund for yourself and how you maximize on returns to try and have a decent retirement. Basically, one of the questions that you might come up with then is the return of investment. So how much you invest does influence how much returns you can make. For example, let's say that you invested $50 or £50 or 50 yen, and you wanted to make a return on that per month of say 5%. Okay, so 5% would be $2.5 or pounds or yen. So you then need to think about, $2.5, $50 initial investment, and then you went on, month by month. If provided that you were able to make the same returns, more or less, or on average every month the same, then that would build up and would accrue. But that's not always the case with Forex. It really depends on your style of trading as well. But provided that you were able to maintain that, then it would start building up. However, if you imagine $2.5 in a year, it's basically $30. So from $50 initial investment, you would add $30. Now that's quite good because it's basically a 60% return added to your initial deposit. But I think that that you'd have to leverage a lot. And that's another thing that comes up, because how much you invest at the beginning influences how much you have to leverage up. For example, if you have a $50, let's write it here. If you had a $50, okay, oops, sorry about that. If you had let's put it here, a $50, and you wanted to have a trade of 1,000. Okay, so what's 1,000 divided by 50? It's 200. Okay, so 50 times, sorry, 20. Okay, not 200. So that's 20 times 50. It gives you 1,000. So that means that you are leveraging up your $50 by 20 times. Okay. So basically with leverage, just to give you an idea, for this we're going to babypips.com and we go to the pip value calculator, a really useful resource. So let's say that you're going into Euro USD, you're going to trade Euro USD, and your position size is how much money you're going to spend on that position. So for example, you buy a position of 10,000 units, okay, and ask price, let's say the euro dollar, it's about 113 or 112 at the moment. Let's put it 112. Value in dollar and calculate. Okay. So at the moment, the pip value is of $1. Okay. So if you were basically opening a position of $10,000, each pip would cost you $1. Okay. So if you had a $50 account, to open a $10,000 position, you'd be using a 200 time leverage. Okay, which meant that every pip that moved will lose you $1. So if the position that you opened moved 20 pips, you lose $20, which would be more than half of your deposit. Now, if you opened instead 20 to 1 leverage position, so 50 times 20, as we said, is 1,000, going back to our calculation here. Okay, 50 times 20 is 1,000. And that would give you a different scenario. Okay, that would give you 0.1. So instead of being $1, it would be 1/10 of a dollar. Okay, so essentially it would take 10 pips to lose you $1. And to lose you $10, it would take 100 pips. So you could then have a slightly wider movement within your trade. So if you wanted to take a trade and profit by targeting a move of 50 pips, okay, this kind of leverage, 20 to 1, would allow you, even with a $50 account, would allow you room to do that. The minimum size of positions is, with most brokers, 1,000. So obviously you can't trade with $5. Some brokers require a minimum deposit of, say, 50. So again, it kind of depends what kind of broker you choose, but do make sure that you ask about that when you choose your broker. So going back to which broker, again, how much money you want to invest. And so as part of that, it's also remembering that if you invest very little, your leverage in order to trade even a 1,000 position is going to be bigger and bigger. So ideally, if you want to invest, you want to speculate, if you like, in Forex without too much risk, ideally you'd have a 1-to-1 leverage. So let's say you had $1,000 or £1,000 in your account, and you open a position of 1,000. So then the leverage would be 1-to-1. Okay. So there would be no, it would be like for like. So it wouldn't amplify your losses per pip. It would be 1-to-1. And that's the best position to be in. Okay, so but just saying, just remember that's a consideration. Number 4, when can I trade? There are different time zones, and this topic has been discussed again on BabyPips quite a lot. So I'm just going to close some of these tabs. I'm going to take you to the different types of time frames, etc. So Oanda, which is also a broker, has a great website with lots of information, and one of the pages is about Forex market hours. Now there are different websites. BabyPips offers that information, and if you look anywhere on Google, type in Forex market sessions, and you find basically these 4. The Asian session, which is divided into for example, the Sydney, so Australia, then Japan, Tokyo, London for the UK, and the American session is New York. Oanda has done a good division here, which is also based on activity within the different sessions historically, and this is basically a volume graph. Okay, and so basically from the Sunday night, trading starts around 10 p.m. GMT with the Sydney session and going on to Tokyo, and then the London opens just after the Frankfurt. So you see a gap here of an hour. Really, that starts with the Frankfurt session in Germany about 7 o'clock, and that's the overlap to London at 8 o'clock. Then London overlaps to New York about 1, and so on. So the busiest time, as you can see, in terms of volume and activity, is between in the overlap between 1 o'clock and here 5 o'clock. So when London and the New York sessions overlap, London has one of the highest volumes of trading, but when New York overlaps, that increases even more. So now that obviously has an impact on your trading, but your consideration is where in the world are you? So obviously, if you're asleep, let's say I'm in London or in the UK, and I wake up at 8 o'clock, and I go to work at 9 o'clock. Well, that only really, if you want to catch the market live, so if I don't set trades and forget them automatically, if I want to be there and click and enter the market manually, then if I want to catch the opening of the London, I need to be online for 8 o'clock, ready to trade. And if I want to trade after work, well, the London one closes at 5, so obviously that limits things a little bit. Some products for the sort of UK-based products, let's say the FTSE 100, and that's equities, but just to give an example, that doesn't stop until 9 o'clock in the evening, for example. So it doesn't have to be that at 5 o'clock everything closes. That's sort of UK based. The FTSE 100 is the UK 100 index that's traded into the evening as well. And also currencies obviously trade 24 hours a day. So just because you're not in London 8 o'clock or you're not in New York at GMT 1 o'clock, let's say, it doesn't mean that you can't catch these markets. Obviously, if again I'm in London and I go to bed at 10 o'clock, I'm going to miss the Asian session. If I want to trade specifically during the Asian session, I'm not going to be able to do it live. I could set orders to kick in for when I go to bed. So if something happens during these sessions, let's say a Bank of Japan rate decision or something that moves the Asian markets more, then that could be a way. The other thing is, obviously, if you're in the Asian session and you go to bed when the European or the North American sessions open, is to think about if you can stay up a little bit later into the night to catch the beginning of these or not. So all these considerations obviously go back to the point of when can I trade? This really relates to the first question, why am I trading? If you're trading because you have a lot of capital and you decided that you want to make a living out of your trading, which is a very big decision because there's no guarantee that you won't lose your money or part of your money, and it's not like an ordinary job where you have a secure wage, etc. But if that's what you decide to do, then obviously you'll be at home during the day, so that means that you can trade the market live as it happens. But again, if you want to trade because you have a day job, but you want to invest some of your money because, let's say, your bank doesn't offer you big returns. In fact, very, very few banks now offer big returns for ordinary savers. Then you might want to go into financial instruments and trade yourself, your money, to make a better return. In other words, to beat the markets, so to speak, or beat the banks. Then you have to think about when you can trade, because if you're working 9 to 5 or sort of 1 to 8, you have to think about when is it a good time to trade. One, in terms of the market sessions that I was showing you, there's no point in being on screen online where there's nothing happening in the markets, because there isn't enough. There are enough big participants in the market to make it move enough for you to make enough trades. And also think about your commitments, because one error that a lot of people make is to make big plans about this sort of trading and then realize that they can't sustain it and they get frustrated because things get in the way. And the things that you used to enjoy start becoming a nuisance because you want to be in front of the screen, but somebody calls you up, they need you. Maybe it's your parents, your boyfriend, your girlfriend, your wife, your husband, your sons, your daughters, your nieces and nephews, your sisters, your brothers, people, people at the door ringing, something happens, your neighbors knocking your door, you're maybe a student and other students want you to go out. You need to think about your environment. When can you trade? When is it quiet where you live? Or if you trade at work, which is very stressful, I've done it. Again, depending on where you work, if you have a lunch break, can you trade during your lunch break? Is it safe enough for you not to be disturbed? Would people frown on you if they saw that you were doing something that they don't agree with, like trading because they have a view about the stock market and Wall Street or whatever? So, about the 2008 crash, There are all these things to think about. Maybe you don't want to be seen. Maybe you're just starting out and you want to share that. So is your screen, facing the wall, or is it facing the office and people can see what you're doing? Are you trading on your mobile phone? If you're trading on your mobile phone on your lunch break or on short breaks, think about what kind of setup you have so that you can see what you're doing without sort of being making mistakes because you haven't got enough space on your phone to show you the charts as you need them. So when can you trade is very important to think about realistically. Can you trade if you have a full-time job and you want to trade around that? Can you trade around family or personal commitments, and how much time you have? Let's say that you have an hour. Let's say that that hour is between the Frankfurt Open in the morning and the London Open, 7 till 8 o'clock in the morning. There are some really nice moves around those times in some of the currencies. So don't really think that everything has to happen between the London and New York overlap. There are some opportunities before that. So let's say that you traded before going to work. Okay, between 7 and 8 o'clock, you live by yourself. You don't have anybody to bother you. Let's say, just giving you an example. So you have time. You have your breakfast. You're in front of the screen, ready for 7. 7 till 8. You leave the house 8:30. Perfect. Okay, so 7 till 8, nice and quiet. You've got your screen on. Everything's. You got your internet connection sorted, and now the decision is what time frame. Okay, so let's go back to our now the time frame is very important here, and I've taken the Online Trading Academy website, www.tradingacademy.com, and they've got this resource which is trading charts, common charting periods. This article is very useful. Now, there's information about this on babypips.com, on Investopedia, on all sorts of websites. Really, it's very, very common to find information about different charts. Your broker, probably, if it's a large broker like FXCM, it has dailyfx.com and to have all the information about that. So it's not difficult to find that, but just go to your chart and really see the different time zones, if you like, and some online charts as well you can find, like on investing.com will give you different online streamed, if you like, time frames. Monthly charts. Let's start the conversation with that. So now, if you're trading actively for an hour, let's say between 7 and 8 a.m., as I said before, you probably want to have small trades, presumably open and close them between that. Alternatively, you may open those trades and maybe just monitor them during the day, maybe on a tablet like an iPad or a laptop or a mobile phone, whatever, and just basically monitor them and then just close them. So once you've done your research between 7 and 8 in the morning, maybe, let's say, then you open those trades, but you can close them. So all then you have to do is monitor them and see if you've hit your profit target, and if the trade is struggling to hit your profit target. So when you're making a trading plan, you're obviously trying to do the time frame analysis based on your needs. So if you're trading for intraday, which is basically keeping trades open during the day and closing them before the end of the day, then you have to choose an appropriate time frame. Okay, so your time frame needs to be appropriate to that. So if you're trading monthly charts, you're not going to open and close trades within the day. You're probably going to open and close trades over a longer time period. So that means that basically you're going to have an idea of trading over longer time frames, like the monthly charts. That basically means that you're going to have a time frame that spans several weeks and possibly months. So monthly charts really suit people who have different. Let's give you an idea here. Okay, so go back to here. So monthly charts probably fit somebody who may be a so-called position trader. The position trader usually has trades that span weeks, months, or even years. Okay, so that means that they are going to basically not trade every day, but they're going to be involved in markets by monitoring their trades and perhaps altering, large stops and maybe profits, or maybe hedge their risk by purchasing options or, making some adjustments to their trades, maybe partially close some of their trades, depending on how they've traded those long-term positions. And so long-term traders, like position traders, and I started trading long-term last year, and I've been holding trades from last year still till now. And if you are, so that will basically suit monthly charts, etc. Okay. So if you are going into monthly charts and also weekly charts, that's more long-term trades, you can still look at them, but really if you're trading intraday, you might be looking at daily charts. So daily charts would really be suitable for maybe swing traders, or perhaps the more common type of trader for Forex or spot Forex market, which is the day trader. So day traders would be looking at daily charts, or maybe 1, 5, 15-minute periods, or 30-minute charts. So that really would be more suitable for intraday traders. Okay. Now, there are also smaller charts, again, hourly charts, 15-minute charts, 5-minute charts, and finally you have the tick trade charts. Tick or trade charts are line charts that represent each trade the market executes. And basically, sometimes they say that these are sometimes used by scalpers. Scalpers are people who make trades out of very small movements in the market. Let's say, just as an example, a maximum of 10 pips, and that's their trade. If they make 10 pips, they're happy. Obviously, not necessarily, but if you trade 10 pips, going back to our example before, that'd be a very small amount of profit, unless you leveraged up quite a lot, so that small movement that you captured would actually give you a significant profit. They say that sometimes these are used because tick charts track out of the money trades that otherwise needed to be corrected. So obviously there's a lot of quote-unquote noise, meaning that there is a lot of movement in tick charts, and it may have nothing to do with the overall trend or direction of a particular currency pair, because it's really the going up and down could be within a very small range, within a larger chart, like a 5-10-minute chart or a 15-minute chart, etc. So you need to really be aware that if you're trading these very small movements, it could whip up or down seemingly without any sense. So that if you are seeing here on this chart movement down, within minutes it could correct up and back down without seemingly following any pattern. And trading over large periods tends to be more about trend following, following patterns, and looking at historical charts. Okay, so think about all these things when you're selecting your trading plan. So finally is question number 6. But before we get to that, I would just recommend one thing, which is if you want a general introduction, use the BabyPips school at babypips.com, which takes you step by step through everything. Also go to Investopedia, which is a very good general resource on finance and education, and try this /university/forex market. And you see this article, Forex tutorial, the Forex market, and it takes you step by step throughout. So starts for a tutorial, introduction to currency trading, okay, and then goes through what is Forex trading, etc. And it just really gives you a very basic introduction. Also, there are some videos in parts of Investopedia showing you the various aspects. But this is a very good resource. So I would really start with something like this, which is kind of a general introduction. So now, just to finish, point number 6 is the if question, which is if I lost all of my capital, then what? So finally, this really painful point that a lot of traders, when they begin, including myself when I started, is what happens when you lose all your money? And that is the big question to ask first. People generally, when they start trading, if they're trading for quick gains, they haven't really made much of a plan, they're just dipping their toes in water, they're going to just put some money in there without thinking too much about losing it, They might lose it all, they might lose some of it, they might get angry, upset, they might not tell many people about losing that money because people will just blame them and telling them they're responsible. So all these things happen when you start trading. Don't beat yourself up about it. We learn from our mistakes. It's important to go through these things. Pain is actually the best way to learn sometimes. If you're too cautious, you're never going to make trades. If you're too risk oriented, you'll make these mistakes. Okay, so you can't avoid it. Basically, one of the things that, however, we need to talk about is indeed losing money. And you remember, if you're new to trading, but you might have heard about it, January 2015, there was a big panic because the Swiss National Bank had basically lifted its floor on the exchange rate Euro Swiss franc, and that basically meant that their currency shot up massively, and that meant that if you were basically a Euro Swiss trader and you buying euros against Swiss franc, you basically lost everything because the euro plummeted. It was like a huge crash. And again, US dollar versus the Swiss franc, anything against the Swiss franc, basically on the other side of that trade, went down badly. So if you were selling the Swiss franc against another currency, you would have lost everything, because a lot of the brokers that provided that currency as part of their forex pairs weren't able to deal with the liquidity drain and the massive imbalance. They couldn't provide enough liquidity to cover for that. So FXCM, for example, had to bring in a third party to absorb some of that imbalance. Some other companies, I think Alpari, went down. So basically, some brokers went bust over that. One day disaster, basically. If that happens to you, in the country where I'm in, which is the UK, the Financial Compensations Authority, the Financial Conduct Authority, has a compensation scheme, and which covers financial losses up to a certain amount. So if you got investments, basically it's up to £50,000. If it's deposits, up to £75,000. Insurance, up to 90% of the claim. So all these things need to be taken into consideration. Your broker, based wherever it is, will have to follow the rules of the country where your account is held. So if your broker is a global broker, but it has an office in your country, and you're trading with that broker in your country in your currency, then you can basically rest assured that they should be signed up to the rules, which would have something about compensation, but you need to check with them and check the small print. Now, this seems really overcomplicating things when you just wanted to get on with it. You maybe have a demonstration account that's paper money. Basically, you've been trading for a few days or weeks, and you're just getting really impatient and you want to skip ahead and try the real thing because you're getting a taste for making money. And that's fair enough. We've all been there, so I'm not saying that it's the only way is to go through all this reading and stuff and waiting months. But certainly, if you invest in real money, if you're investing a very small amount, even think about what that money could buy you. If you're basically just gambling that money away, then just buy a lottery ticket, go to a slot machine place, or maybe just buy yourself a nice, objects, luxury good or something. Go on a small trip, buy a lot of petrol, put it in your car and drive away. Buy somebody a present, buy yourself a present. Go and buy a pet. Just think about what that money actually means to you. And if you really have no fear of losing that money, then go for it. But even with all that, you should have an idea at least of these schemes that protect you if you lose your money. So just going back to our list, make a trading plan. 1, ask the why question. Why are you trading really? Is it to become a millionaire overnight? Then forget it. If you trying to trade because you want to make better returns than what your money would give you if you put it in a bank account, for example, then okay, that's like a business plan. Great. Which broker? Again, minimum deposit and no dealing desk. What kind of products does it offer? Check all those things. How much can you invest? Again, depending on what your broker deposit minimum requirements are, and how much you want to invest depends on why you're trading, the reasons for your investment, and how much money you're willing to lose. When can you trade? Do you work full-time? Do you work part-time? Do you have family commitments? What sessions, which part of the world you're in, what sessions are the most liquid for the currency pairs you want to trade, and also what time frame. So again, are you an intraday trader? Are you going to trade on over longer term periods? So that determines whether you trade tick charts, 5-minute charts, hourly, daily, weekly, monthly charts. And finally, if you lost all your capital because you were silly, you overtraded, and because you were bored, or you lost money and you wanted to trade to make that money back quickly. So, or if you lost all your money because something happened, like the Swiss National Bank disaster, January of 2015, and not because of your fault, your broker went down, basically went bust, and took all your money away. What happens then? So protect yourself when you're trading, not just using stop losses on an individual trade. Think about how much capital you risk when you trade, but also protect yourself. Have some kind of insurance, i.e. ask your broker if you're not sure, read the small print, and make sure that there is some kind of protection scheme. But even that doesn't protect you, because if you lose your money, it might be quite a long time, maybe months, before that broker is able to countersign some sort of deal with a liquidity provider that can come and provide emergency funds for the broker to absorb all the losses and pay back the customers according to the regulations. But even if the government backs the broker and or backs you for your losses, it might take months. You have to apply, you have to demonstrate that the loss was not your fault, it was the broker's fault, bloody blah. So it might take a long time. So again, don't rely on that money. If you're risking that money in a forex trading account, don't rely on that money for your living, everyday living, and think about that. So I hope you've enjoyed this presentation and this video, and if you have any questions, please leave comments on my website, and thank you for listening. Good luck trading. See you on my next beginners series video coming up soon.